Most people think inflation simply means higher prices. Groceries cost more, rent increases, fuel becomes expensive. But inflation does something far more powerful behind the scenes. It quietly reshapes how wealth is distributed across society. For many households, inflation slowly erodes purchasing power. But for asset owners, the same force can dramatically increase wealth. To understand why this happens, we need to examine how modern financial systems actually work. In simple terms, inflation means that money buys less over time. A currency slowly loses purchasing power. This happens when the supply of money grows faster than the supply of goods and services. Central banks, such as the Federal Reserve, manage monetary policy to stabilize economies. But even moderate inflation compounds over time. A 3% annual inflation rate may appear small, yet over decades it dramatically reduces the real value of money. Inflation does not affect everyone equally. People who rely primarily on wages are the most vulnerable. Their income grows slowly and often struggles to keep pace with rising costs. But people who own assets experience inflation differently. Real estate prices increase, stock markets expand, business revenues grow alongside rising prices. In many cases, asset values rise faster than inflation itself. One of the most important consequences of modern monetary policy is asset inflation. When interest rates are low and liquidity increases, capital flows into financial markets. Investors purchase stocks, real estate, and other assets. As demand rises, prices increase. This creates a powerful feedback loop. Asset owners see their wealth expand, even while everyday costs rise. Wealthy individuals also benefit from leverage. Leverage means using borrowed money to acquire assets. If inflation increases asset prices while the value of debt remains fixed, the borrower gains. For example, a property purchased with a mortgage may double in value over time. Yet the debt remains constant in nominal terms. Inflation quietly reduces the real burden of that debt. Wages, however, rarely adjust at the same speed. Salary increases are gradual. Contracts and labor markets slow the adjustment process. Meanwhile, the cost of housing, healthcare, and education often rises rapidly. For many households, inflation feels like running on a treadmill. They move forward in income, but never truly gain ground. Financial markets are particularly sensitive to monetary policy. When interest rates fall, borrowing becomes cheaper. Investors move capital into stocks and other assets seeking higher returns. This dynamic pushes markets upward over long periods. It also concentrates wealth among those who already hold financial assets. Over time, this process widens the wealth gap. Asset owners benefit from appreciation. Non-owners face rising costs. This divergence is one reason wealth inequality has expanded in many advanced economies. Inflation does not simply raise prices, it redistributes economic power. History offers many examples. Following the global financial crisis of 2008, central banks implemented large-scale monetary stimulus. Financial markets surged in the following decade. Property prices reached historic highs. Meanwhile, wage growth remained relatively modest in many sectors. Inflation also influences behavior. People feel pressure to spend quickly before prices rise further. Saving becomes less attractive. Investment becomes necessary just to preserve purchasing power. This shift encourages participation in financial markets. Inflation is not simply a flaw in the economic system. It is a structural feature of modern economies. Governments seek moderate inflation to stimulate activity and manage debt burdens. But its consequences extend far beyond price levels. Understanding inflation changes how individuals approach money. It highlights the importance of ownership. Assets, leverage, and long-term investment strategies become critical. Those who understand the system can navigate it more effectively. Inflation is one of the most powerful forces in modern finance. It quietly reshapes wealth across generations. For some, it erodes savings. For others, it multiplies assets. Once you understand this dynamic, the architecture of the financial system becomes clearer. This is Capital Blueprint, Subscribe to understand the forces shaping the global economy.